But there are also a lot of brokerages. A very interesting note from UBS where they have initiated coverage on a lot of these consumption companies like Sapphire, Devyani Foods, etc. Hormaz is here to give us, all of the brokerage notes for the day. Hormaz, good morning.
Morning, Sonia. And as you mentioned, UBS has initiated coverage on 5 food and beverage companies in the country. And starting off with United Breweries, Sapphire Foods and Devyani International. These 3 stocks where UBS has a buy recommendation and is expecting potential upside of anywhere between 14% to 25% over the next 12 months. And the other 2 names being Varun Beverages and Tata Consumer, where it is a neutral rating and is expecting upsides of anywhere between 9 to 11%. Now, UBS is also saying that India's QSR space is set for a multi-decadal growth going forward, and it prefers, within that space, it prefers Sapphire Foods due to the valuation comfort that it offers. Next up is Nomura on Kotak Mahindra Bank, where it had a neutral rating and has a price target of 24.40, and it mentions that deposit mobilization remains a challenge for the bank, as it has been mentioning over the last few quarters. However, the bank does not see any challenges on the loan growth front, is what Nomura is saying, and it is expecting the loan growth for Kotak Bank to be anywhere between 1.75 times to 2x of the nominal GDP growth over the medium term. And lastly, it is also not seeing any asset quality concerns in the unsecured retail portfolio that has been in focus for a lot of these banks. Lastly, Goldman Sachs has come out with a note on the power sector on the CERC's final tariff guidelines for FY25 to 29, where it says that the guidelines are pretty much in line with what the draft paper said, and it also mentions that it continues to like NTPC, as the stock will be a dual beneficiary of the coal capex revival and the renewable energy business at an inflection point. So a positive note there on NTPC from Goldman Sachs. Back to you.
Hormaz, thank you very much for that. Now to